The Palantir IPO in September 2020 was a huge topic for tech and software investors. Since then, Palantir stock has more than tripled. The IPO price was $10 a share and Palantir stock now trades at around $33 as of this recording. Many investors have high hopes for Palantir's future, which is of course reflected in the current valuation. As of now, Palantir is valued at $62 billion. That's reason enough for us to take a closer look at Palantir, its business model and the current financial situation to determine whether or not Palantir stock looks like a buy to us. Let's dive right in. Palantir Technologies Incorporated is an American provider of software and services within the field Big Data Analytics. Some of Palantir's customers are intelligence and defense institutions. 2019, Palantir Technologies generated annual revenues of around $740 million. We'll start our analysis by looking at the business model. Palantir is often viewed as a secretive company, which is to some extent true. The reason for this being that till recently most of Palantir's customers have been intelligence and defense institutions, which of course require total confidentiality. This led to the fact that most of the time very little about Palantir's business has been known by the general public. Palantir was obliged to remain silent about their business. They even were prohibited from correcting false assumptions concerning their business that emerged from speculations by the public. Nowadays, Palantir's customers include several companies from different economic sectors, which allows Palantir to communicate their business model more open, at least the part of the business that involves the companies. So Palantir is now able to explain how they create value to the customer and generate revenues. In contrast to most other data companies, Palantir is neither a data broker nor a data aggregator, meaning that no customer data is collected, sold, or otherwise passed on. Palantir also restrains itself from using the data for their own purposes, like for instance training machine learning algorithms. Instead, Palantir offers software and infrastructure, therefore this business can be classified as a SaaS and IaaS business model. The products of Palantir mainly include infrastructure for data operations. Hereby, Palantir softwares operate as connective tissue between the already existing databanks, analytics capabilities, and operative execution of the customer. Palantir software enables the executive to access all necessary information and analyze them with sophisticated analytics applications when making a decision. To the customer, Palantir software creates the value that at the right time they bring together and analyze all data necessary in the decision progress. This is particularly helpful if there is no existing connection between the different systems of a company like the databanks and analytics applications. A good example to show the value of this can be the question how much of a good should be produced. Several factors like specific information about the production process, the available financial resources, the current inventories, and customer behavior have to be factored in. That's pretty hard to do if there is no connection between the databanks, the analytics applications, and the executive branch of a company. Palantir softwares obtain all the data necessary from the databanks, analyze it, and present the results to the person making the decision. To monetize this business model, Palantir licenses the usage of its software to the customers. Because many of its customers are intelligence and defense institutions, Palantir operates with world-class data protection. In its relationship to the customers, Palantir is merely a data processor and not a data controller. The customer itself determines what can and what cannot be done with its data. Palantir staff helps the customer with the technical implementation of their project. While doing so, they strictly follow the instructions of the customer. Every abuse of data makes Palantir vulnerable to criminal persecution and of course revokes the trust basis of its relationship to the customer. Because of this, Palantir is very careful that all data remains strictly confidential. We'll now take a look at the cost structure and margins of this business model. The only cost of revenues are the expenses for the implementation and operation of the software and the cost of services. After these expenses, Palantir has a gross margin of 63.4%. The operating expenses are evenly divided into research and development, sales and marketing, and general and administrative expenses. All these expenses are incredibly high, which results in an operating margin of minus 132%. After finance cost, the net margin is minus 132.1%. This means Palantir is losing a whole lot of money. In a year, they lose more money than they generate in revenues. Which competitors are there and how is Palantir's position within the market? To answer this question, we'll take a look at a statistic that shows the market share by company for data fusion platforms and analytical applications. Within this market, Palantir has a market share of just 1.17%. The biggest providers are MATLAB with 13.03%, HubSpot Analytic with 12.28%, Alteryx with 7.43%, Click with 6.93%, Paris with 5.07%, Base SAS with 4.63%, Stata with 4.08%, SAS Enterprise Miner with 3.71%, Arcadia Data with 3.13%, and Numphy with 3.1%. There are many more smaller providers, including Palantir. This market can clearly be classified as a polypole, and there are no really dominant providers. The position of Palantir compared to its competitors is quite bad, but we have to remember that a significant part of Palantir's customers are governmental institutions which are not represented in this statistic. This statistic merely shows the market share within company websites, which to be fair is not the core business of Palantir. We can assume that Palantir's market share within this niche market is significantly higher. But it is quite clear that the most monetary potential does not lie with governmental customer groups. So in order to be really successful, Palantir certainly has to increase its market share in the market with companies as customers. Before we'll now look at the management of Palantir, we ask you to subscribe to this channel and activate the bell if you like our videos. Thank you, and let's continue with the CEO of Palantir. The first search suggestion that comes up if you type in Palantir CEO into the Google search engine is Palantir CEO hair, and I now understand why that is. The man with the mane is Alex Karp. He is one of the co-founders of Palantir and leads the company as CEO since the founding in 2004. He holds a bachelor's degree of the Haverford College and also holds a law degree of Stanford University. He got a doctorate in Germany at the Wolfgang Goethe-Universität Frankfurt am Main. Currently, he is worth around $3.6 billion, which he holds mostly in Palantir stock. That means he sure is keen to increase shareholder value. How is the capital of Palantir utilized? The capital structure is 0.09, which is extraordinarily good, but not expressive at all because the company is still financed from the outside. There is slim to none goodwill, which of course is positive. The capital turnover ratio is 0.39, which is better than Alteryx's capital turnover ratio at 0.31, but weaker than the one of HubSpot at 0.43. How do the investing and dividend policies of Palantir look? Currently, the company invests 60.5% of revenues in research and development, which is great, but of course the figure is only this high because revenues are still small. Sadly, sales and marketing as well as general and administrative expenses are even higher. Since Palantir is still far from being profitable, no dividends are paid. The next and probably most interesting point we'll examine is Palantir's growth. Unfortunately, we have a very limited time frame of just 1 year to look at. But from 2019 to 2020, revenues grew by 50%, which is strong, especially if we consider what a year 2020 has been for most companies. Even some of the fastest growing companies out there reported growth rates significantly below their usual ones. Before we look at the factors of influence concerning Palantir's future business, we'll now assess the financial situation using some of the most important ratios. The liquidity is very pleasing with the current ratio of 2.54 and a cash ratio of 1.91. Since the company is not profitable yet, the profitability ratios are obviously bad. The return on assets is a negative 52% and the return on equity is a negative 108%, meaning that in 1 year the company loses more than it has in equity. The cash burn rate is just 1.3, so the company can cover its losses of 1.3 years with the current cash on hand. Palantir's equity ratio is 48%, and if we take a look at all those ratios combined, it's pretty clear that Palantir is gonna need another financing round, which of course leads to a dilution of shares. What are the most important influence factors on Palantir's business? The general outlook for the market Palantir operates in is great. In a world where more and more data is produced, the efficient management and analytics of this data of course becomes increasingly desirable. So in my opinion, it's safe to assume that this market will continue to grow in the future. Sustainability is not a problem for Palantir because with the mostly digital business model, they can easily make their operations fully sustainable. An increase in interest rates is of course harmful to every non-profitable business, but frankly, I think that this little amount of extra losses won't determine whether or not Palantir will be successful, since it's a drop in the bucket compared to Palantir's other losses. The competition within Palantir's market is intense and Palantir does not have a good position in this market yet. I think for Palantir to become successful, a far better position in this market will be necessary. Palantir's business might be a little cyclical since it'll be hard to gain new customers in economic downturns. But this factor shouldn't have that much of an influence, and during the current crisis, Palantir performs extraordinarily well. In my opinion, the most important influence factor is that Palantir's losses are still huge and even have a growing tendency. This makes another financing round with equity investors inevitable. If we look at the current valuation, we find that Palantir is really expensive at a revenue multiple of 60 and at a price-to-book ratio of 50. Because of the huge losses, the weak market position and the high valuation, we do not buy Palantir stock, although we really like the business model and market. Here you can watch some other of our analysis. Thanks for watching, and hopefully till next time, Tristan and Charles of Stock Simply Clever.